Greetings, everybody. This is Jeff Scott, and this is my weekend review. It's August 15th, 2021, halfway point in what is typically a difficult month. I entitled today, Are Your Accounts Getting Chopped Up? I had some technical difficulties with my recording, so hopefully this will be okay this time. Again, my name is Jeffrey Scott, and my email address, as you can see, is hgsidoc@gmail.com. If you're watching this on YouTube, just a couple of hints. You want to go down to the 4K little gear in the lower right-hand corner. Well, it's actually the gear, and if you click on it, you can adjust the resolution. I record this in 4K, and it looks better in 4K if you have access to that. If you have comments, you can email me to that address. I respond. And questions, whatever, you can also put them in the remarks section in YouTube. And if you like this, please hit the up thumb. If you don't like it, the down thumb. But, anything you can do that helps to get my numbers up can probably get more distribution. Although since I do this for fun and I'm an unpaid volunteer, it doesn't really matter. Guess it's about the ego. As always, it's for educational purposes only. I'm a doctor, not a broker. I'm independent. I paid for the tools that I use, and trading involves risk. It's funny, I often comment about the Options Industry Council with some great education. They actually had an email today talking about their 60 educational videos for all levels of option traders. I always refer people there because I do talk about options, and powers that be deem options to be more risky. When I do any kind of education, I call it Be Your Own Guru. These are some of the folks that influence my style. I could be adding to that. I've been listening to Rob Hoffman some with his wealth charts, always expanding the folks that influence me. And what I try and do is I take what I've learned from each of these and put them together in a trading style that works for me. It's funny, people like Gil Morales, who I became friends with over the years, have talked about how cancelim's not working, and he takes a lot of heat for that. Wait till you see a slide of the 50 versus the FANGs and the S&P 500 since inception. It makes you wonder if that's not an accurate statement. I own everything you can think of. I had a call with a guy, a new friend, on Friday. And he said, I got something to show you. And I sort of thought, yeah, $10 says I already own it. And I did. It's a pretty cool program, besides the point. But if you come during the day, you're going to find TradeStation and Thinkorswim open. And I forgot to update this slide, but you're also going to see wealth charts. And then each thing is populated by various indicator sets, whether they're Dr. K's, Sagar's, John Persons, and others. From time to time, I'll mention specific products. I might even have the people that are proprietors of those products to come online. I do this as I can't say service because you're not paying me for anything, but as a vehicle to educate and to introduce folks to some of the people whose work I follow. I never get paid for that. If you buy something, I don't get paid for it. I'm truly an unpaid volunteer, and this is just education from an amateur, I would point out. HighGrowthStock.com, that's the website for HGSI, the software. I have no financial interest in it. I have no control over it, but I use it. And under free 30-day trial, you get access to the program for 30 days. And they don't even ask for a credit card. Eventually, this is changing. I should be checking more often because one day it's going to change and I'm not going to know. And then under investing strategies, you'll see hundreds of movies. Stock patterns are cyclical. I have this discussion every week, frankly, every hour of every day that I'm looking at a stock. And there's certain things that I know. I know that every stock, index, industry group, sector, Bitcoin, I don't care what it is, goes through this pattern. And it goes through this pattern over and over again. And if you think about an uptrend, it's the same pattern, but you have a higher low and then a higher high, and a higher low, and a higher high. So you'll see this, and it's also very fractal. You'll see it on every time frame. Now, the stocks that we trade go up like rockets, but they fall like rocks. And you really need to know where these stocks are before you buy them. And sometimes it's easier to have this discussion looking at weekly charts. Yes, we keep getting higher highs, especially on the S&P and the Dow that hit new highs this week. They're not massively higher highs, but they're higher highs. And so every time it's looked like this market wants to roll over, it quickly takes another leg up and gives us a higher high. The question is, does that go on infinitum, or is that something that's going to end? Now, in reality, it still feels like a sideways market with just a little upward tilt. And on those downstrokes, you're getting chopped up, and so am I. And not only am I getting chopped up if I'm in the wrong stock or the wrong industry group, but how do you trade a market more than very short term when it's bouncing between growth and value, risk on, risk off, and then you got the industry and sector rotation? This is a very tough market. If you feel like it's hard, you're right, it is hard. So what have I done? Cash, smaller position, sold premium. Now, I've done stupid things. I've still been long some things, and I've gotten punished. And then the other thing that's hurt is you keep thinking, or I keep thinking, we're going to roll over. But until you roll over, you got to be careful with contra ETFs. Now, it was funny. I was watching a show on Thursday, a video with the guy I mentioned, Lori Jones, and he put up a chart of Best Buy. Maybe it was Wednesday. I can't remember which day it was. And I go, that does look like something to short. So I shorted Best Buy for 2 days and had a nice return on that. Guess it pays for some of the computers I buy for it. But I think the key wasn't that I had a good return. For 2 days, I shorted it. I think, and there's just, it's very difficult for long term. Now, my long term positions, I still have them, and I've got some of them collared. But entering new positions, I'm thinking short term, and I'm very careful. Now, that was ugly sounding, but here's reality. Still a lot of green on this chart, and the green is it's everywhere except in, let's see, materials look kind of poopy, don't they? These are the stocks of the material ETF, mostly red. Energy looked horrible. Financials, which were strong on the week, can't believe that all these were really flat. Sometimes the thing resets and I don't know, but lots of red. Industrials were mixed. Staples, defensive, mostly green. Technology, 2/3 green. Discretionary, about 50-50 at best. Utilities, defensive, very green. Healthcare, mostly green, can also be considered defensive. And then look at real estate, again, mostly green. So there's no question that even within the S&P 500 sectors, that it was the defensive things really led. Now let's look at the major markets. Now, for those who've not been here before, I spend 30 to 40 minutes on the market, and I do it for a reason, because the market's going to dictate whether you're long or short and to what degree you want to pile on. So I really want to understand the market. So here's a year's worth of the S&P futures. One of the advantages of looking at futures is there's not a lot of gaps. Not quite 24-hour trading, but close. So the first thing I notice is this white bubble here tells me that on this 1 year look back, the all-time high was hit on Friday. So you got to be bullish, right? If you hit the all-time high, maybe, but things roll over from somewhere. Now, in fact, this is a pretty steady uptrend going back. It didn't come out of the chute as fast as the Qs, but still a very nice roll up going back now a year. Are you bullish or bearish? You got price. The green here is a 17-day simple. The yellow is the 50-day simple. The red is the 200-day simple. And these are some Fibonacci bands that I drew in on the pullback. And we used to pretty much would stall out at each of the lines. And then we would break out and go higher. Now, what's not bullish on this chart? This, higher highs and no volume. So if you were looking for a reason to be concerned, that's a pretty significant divergence here. Now, one could argue it's the end of summer, everybody's in the Hamptons, everybody's on vacation, and no shocker that there's no volume. And that may all be true, but that's a flea in the ointment here. Let's look at the Nasdaq Futures. Now, when you look at the word tight, this is pretty tight. I mean, especially of late, with very little movement here. And you compare that to the Nasdaq, which is a little bit looser. And if you look at the S&P, sorry for going back and forth on you, it's pulled back to that 50 and bounced multiple times. And the last time it spent any real time below the 50 was back in October. Now, the Nasdaq has had a sideways component and then a recent breakout here. It's kind of going sideways again. It set its all-time high a week ago and really just went sideways this week. So not the same energy. Riding the 17-day, which is never a bad thing, above the 50 and the 200. Bullish or bearish, if you have to pick one, you got to be bullish. You're right off the all-time highs. But notice on the S&P 500, you have a green John Person buy signal. And on the NASDAQ, you have a sell signal. So is that a big deal? No. A breakdown below here would be a big deal, a bigger deal. I just think you've got a little bit more to be concerned about on the NASDAQ. And notice a couple of deep cuts here of the 50 when they were going sideways. The Dow, another one that hit all-time highs, these are the futures, had a red candle day, which means it set a high and it came down off the high. It actually looks like it traded lower on the day. Like the NASDAQ, new highs, beautiful uptrend. Now, the Dow is going sideways and it looks like it broke out of its sideways consolidation. So again, something that might be considered very bullish. I'm just not very bullish right now, but I respect the fact that the Dow futures did break above its high, where you could see on this little white line, it was bumping up against and falling back, going back since May. So that makes me a little bit more optimistic. What's not optimistic is the Russell. The last high was set back in March. This was a time to make money. My God, coming off in the fourth quarter, what a move on small stocks. And since then, it's just digested them and gone sideways. Am I bullish or bearish on this? It's hard to be bearish. It's hard to be bullish. You could put a line here. You could put a line up here and say that we're bouncing back and forth within that box, and we're sort of in the middle. To the bearish camp, we had what's considered an ice hole failure here, where we had 1, 2, 3, at least 4 attempts at getting above this 50 and failed. We also broke through the 17. Now, based upon what I learned from David Elliott, it wouldn't surprise me to see this come back to the 200. So this one is not the same as the other ones. Again, a new John Person sell signal. It's a sideways market. Sideways markets can go up or down. I don't feel aggressively that it's going to go down, but it's hard for me to be excited and want to be jumping in and buying a ton of TNA with this pattern. Yeah, a TNA from here up to here was great. I'm not a short-term trader. I'm more of a long-term trader, and this is oscillating on a sideways market. I like to look at the VIX, and this is sort of interesting. I'm feeling less positive about the market. I think that's probably obvious in my tone, yet the VIX is as low as it's been. And then lastly, the dollar. Now, this should have helped small stocks on Friday with the dollar taking a hit. Now, on the daily charts, the dollar's at the top of a range. It looks like it might be reversing. It has a sell signal. A falling dollar probably would be good for my stocks. I seem to do better, and I'm not heavy in gold right now. I seem to do better on a weak dollar. But if I look at in the longer time frame, just switch this to weeklies. Just want to point out a couple of things. The dollar is at the top of its range short term, but it's way off of its highs. And if you want to know when the Russell was doing so well, was in this period of here when the dollar was almost in free fall. And why is the Russell's now going sideways is the dollar's going sideways. You can see how strong the S&P is, the Nasdaq, and even the Dow. I don't know why it shoots to here. And you can see this one's not like the others, a definite sideways move on the weekly chart. All right, enough of that. Let's look at the expected move chart. Boring week, a good week to be selling options. Remember, the expected move is set by it's determined by the option selling market makers, essentially. And it's an at-the-money straddle. And it basically, if you buy it at the money straddle, you're buying a call and a put at the strike price. And typically, you'd expect the premium to be the amount between the center and the expected move up or expected move down. And therefore, if you're selling those options, as long as what you sell, as long as you stay within the green and the red, you make money on selling the options, and the person that bought the options loses money. If you look over time, about 80% of the time, the indexes stay within the expected move. So again, selling options here turns out to be a better way of making money. Now look at how little change here on the S&P, although it had a bump up a little bit on Thursday and sideways on Friday. Here's 2 weeks ago, 3 weeks ago, 4 weeks ago it had some move, but within the band. 5, 6, 7 weeks of staying within the expected move. 1 out of 7, 1 out of 8 would be 87%. And that's about, it just shows you how little excitement has gone on in the S&P. Nasdaq's a little different. Nasdaq for the last several weeks has stayed within, but here's a week where it closed above. Wait till you see the Russell. What does this tell me? Well, it just tells me that nothing happened this week. But what I look for, and when I see one, I'm going to let you know. Here's what I look for. Here's a stock. This is the Nasdaq Futures, traded intraday below the expected move. Had a hammer here back inside the expected move. That's a clear-cut reversal. You want to buy that the next day on the open, and you got a nice move up. So I look at it to find reversals to enter or exit a market. Here is the Dow Futures. Similar thing here on Monday, a month ago, traded below the expected move. That's not expected. But it had a reversal day back in on Tuesday, and you knew it was an opportunity to get back in the market. So more movement here this week on the Dow Futures, but for the last 3 weeks, staying within the range. So not a whole lot of help. The Russell, yeah, this is what scares you. And typically, again, about 80% of the time, they're going to be within the green and the red. and the options makers make money. Often when they break below the red, they have a reversal or very quickly. But it turns out that when they break through, they can keep on going. And you had some pretty profound moves here. Let's go back now. 1, 2, 3 weeks was pretty much closed every day within the expected move. So a much quieter market again without any signals from here. You can look at the VIX and you can see the VIX actually closed down below the expected move, or pretty much right inside the expected move, and the dollar again within. So some weeks we see some massive move in the expected move. Didn't see much this week. Now, I've spent some time of late playing with these charts, and I always learn something from these charts. Remember, the market rolled over in February, March of 2020. So this is looking at the S&P 500 versus the equal weight S&P 500. If you think about the S&P 500, Facebook, Microsoft, Apple, Google have a huge weighting and a huge influence over, among other big stocks, NVIDIA. And clearly in the big run up to the peak in 2000, it was led not by the equal weights, but by the spiders. After the top, the equal weights were outperforming the spiders. Now, it turns out in March 2009, when the market reversed, the RSP actually outperformed the SPYs by quite a bit. Well, what happened of late? We had a reversal with the spiders leading, and now the spiders are failing. Now, the last time the spiders failed is when the market rolled over, so something to watch. How about the S&P 100 versus the S&P 1000? Again, on the way up to the 2020 peak, the larger stocks were leading the more general, and what happened after the market started to recover is we've had a period of time where the soldiers were leading the generals, and that's why this was coming down. Then in early this year, a reversal with the generals back in charge, and now it's weakening again. Nasdaq 100, the generals versus the soldiers, the Nasdaq composite, going up to 2020, the generals were leading. After the recovery, interestingly, the soldiers were leading until early this year. The generals started leading again, and now they're going sideways. I don't know what I learned from this, except this is part of that rotation down into the depths of the index. And the last time these things rolled over, whether it was a SPY versus RSP, the 100 versus the 1000, the Qs versus the NASDAQ, it didn't give warm, fuzzy, good things for the market. This thing blew me away. It's going back to 2016. I'm going to look at this again. The IBD 50 ETF, all right, the curated list of stocks in Investors Business Daily, investors.com, following the philosophies, many of which I follow to this day, of Can Slim and Bill O'Neill, underperforming the Wilshire 5000, which is a very large and broad index. That's sort of bothersome. Look at the FANGs, and you see the FANGs outperforming that index. So clearly this has been a general leading the soldiers, with the IBD 50 being often smaller growth stocks. And then the other thing that I look at closely is the S&P versus bonds, so spiders versus TLT, and you could see that during the strong markets, and stronger markets, perhaps 17, 18, 19, the spiders led the TLT. When you had a breakdown of that in 19 and 20. You had the ultimate breakdown at the top of the market where the spiders underperformed, and then this massive bounce off the bottom to new highs has been the spiders just killing bonds. And now we're going sideways. Now, if you look here, you can actually see we took a leg up this week. So I follow this because I like being in stocks when stocks are doing better than bonds. And maybe this is showing me improvement is coming. Why do I watch this? I could have put a chart up and said this is today higher highs, staying above the moving averages, but I didn't because this is really 2007. And what happened in 2007 is ultimately we broke below, this is a 200-day moving average, and here's the spiders versus bonds. As long as spiders are above bonds, you probably are doing okay trading stocks. But you got to watch that because a break in spiders versus bonds, or you can flip it up, bonds breaking out versus spiders, probably is concerning. Does CanStim still work in 2021? I'm not going to give you an answer except show you here is the performance from the launch in in 2015 of the IBD 50 ETF versus the spiders. Grossly underperforming the spiders. So it's not just the Wilshire 5000. Here's the FANG. It's a newer product, started in 18. And you could see of late outperforming the spiders. And then if I compare FANG versus 50, I want to be buying the generals and not the soldiers. Took this from something that came out from All Star Charts. That's something I subscribe to. I really like the service. They do an hour of charts a couple times a month, monthly candlesticks, and Monday is their monthly chart review. The guy, they're good, and some of their calls have been great. I've made some money on their calls. I knew that sentiment took a hit on Friday. They had a nice graphic. And if you look at where the U.S. index of consumer sentiment is, big underperformance this week. It is lower than it was at the bottoms of the market. And you have to really ask yourself, is this a time to taper? Let's look at underneath the indexes. I know I've gone very deep. This is a half hour, so probably be a longer than normal video. Rates settled higher, so you can see a little tick up on the 10 and the 30-year bonds. Rising rates are good for banks, especially regionals and insurers. We talked about banks last week. That wasn't a bad call. If we look at AD lines versus the index, the AD lines are in white, the indexes are the color. If I look at small stocks, we are well below prior highs on both. If I look at large caps, we are above prior highs on both. So we are clearly, the large caps are leading. If I look at the NYSE, concerning. We've rolled over. We've got lower highs and lower lows. I guess we have enough data points, or if this comes down and gives me a new low, to say I'm in a downtrend on AD line. I'm probably being a little aggressive. You can see small stocks have turned down. Transports, which were leading to the downside, have turned up. And then the big cap, the generals, the spiders, the diamonds, and the Qs. All right. You got 5,000 plus stocks. I mean, in HGSI, there's 10,000. Probably 1,000 of them are SPACs, I think. It seems that way. But if you take of the big boys, 500 in the S&P 500, 100 in the Nasdaq 100, and 30 in the Dow, which there's going to be some overlap. You probably got 600 stocks. Those 600 stocks are leading, and I think the rest of the market is lagging. Bonds were up a little bit this week. Rates were all over the place, and I think that sentiment probably spooked the market a bit. Breadth, stocks above the 200 actually ticked up a teeny bit. Continued down a teeny bit. Stocks above the 40 ticked up, as did in the 21-21, they actually came down some. So what is this telling me? That's a 12-week new high, new low. I think breadth, stable, minimal change this week. Shorter term stuff maybe picked up a tad. McClellan, it'll be interesting to see if we can break this long-term bearish divergence on the oscillator. I didn't run it across. It looks like we took it out, but we came right back down, so that will be interesting to see. This is the daily summation index. Again, higher highs here on the price, and nowhere close down here. What are we looking for? We're looking for extreme extreme readings, which signal a market reversion towards the mean, which we saw back here. We are looking for divergences, which we've had forever, and we're looking for zero line rejects. The weekly McClellan, again, all-time highs, certainly not all-time highs on oscillator or summation index. Buckets, take all the stocks in the S&P 1500, put them in their Bollinger Bands. 2/3 of them are above the midline. That is bullish. I don't have any extremes here, so all I could say is this looks like a bullish market in the S&P 1500. Fascinating finding here. We've now had in the last 3 weeks 1, 2, 4 Hindenburg omens on the Nasdaq. Now, Hindenburg omens, sort of folklore in the market. It signifies the professionals getting out and the amateurs getting in. You see highs and new lows. It typically precedes major market sell-offs. Now, what does that mean? Excuse me. It means there's not been a major market sell-off without a prior Hindenburg omen in 50 years. Most of these have small pullbacks. 1 out of 4 are significant. But the big asterisk is there's nothing on the NYSE. There's just no new lows on the NYSE. So I have to discount this because the Hindi is calculated on the NYSE, not the NASDAQ. It still causes the hair on the back of my neck to stand up a bit. Market tone, mixed, really minimal change over the last several days. Now, if you look at the fundamentals, which would include EPS rank, relative strength rank, group rank, or ERG, which is the 3 added together, of a week ago, and then you run the performance over the past week, you got to throw out the head because there are very few stocks to throw out the tail. There is nothing. I can't call that a trend, except most of the stuff was negative. EPS rank versus gain, yeah, maybe the higher ranked stocks had a little bit less of a loss. Higher relative strength did not matter. This was just a messy week. Now, the one problem here is I got a lot of short positions. So short positions, and when I do the group performance analysis in HGSI, it only gives you the long. It treats everything as a long. I was up a few pennies this week, mostly because of 2 trades that I'll talk about. So I'm just going to call mine neutral. My buys, that was sort of did nothing. My overall buy watch was up a little bit less than 1%. The S&P 500 was up 0.78. And then the IBD 50 type indexes were smattered above and below mine. So this is a week where the IBD 50 outperformed growth. Interestingly, think back of the last couple of charts I have, when I looked at those ratio charts, probably not that unusual. Sector strength, mostly green. I'm looking here at the Woody indicator. But let's look deeper. Using the Q Edge tools, we'll start up here with the pie charts. The first row is sectors, the second is industry group, the third is stock advanced decline. So what this looks like during the day is this. And what I have the ability, and I just love it, I love this tool. So you'll see that this one day here and one day, on Monday morning, this will turn into real time. So during the day, I'm able to look at how the market's doing, what percent of sectors are up, industry groups, or stocks. Well, at the end of the day, the real time and the one day are the same. So you can see that 27% of sectors were positive on Friday, not a big number. 31% of industry groups and only 40% of stocks. So not a strong day for the market as a whole. Again, this is the S&P 1500 we're measuring off of, not the S&P 500. If I look on the week, it's kind of a 50-50 week. And if I look back at 10 days ago or 2 months ago, the market has weakened. Okay. This one here is telling me that my buckets, which we already know are 65%, this would be Friday buckets. These are Thursday buckets. Right. What is really cool is I'm able to watch extreme changes occurring during the day, looking for the number above 10 or less than 1 to start to get in the 20s and 30s, because it almost always signals a reversal. If I look at the sector performance, again, the market's closed, it's the weekend, 3 of them were positive on Friday. Staples, real estate, utilities. What are those signifying? And yes, they might be different than your spider ETFs. This is a broader market review. They're showing me defensive stature. All right. If I look out over 1 and 2 days, it's even weaker looking at a 2-day window. And if I look on the 5-day week, it was mixed, 6 winners, 5 losers. And you could see over the last month, there's been weakening there. Now, the next thing I can look at in the Q tools is sector rotation. And again, the first column is going to be blank because, I hope it's, here you go, because the market is closed. We're looking at it today, August 15th. Let's rank them. And we could see here that staples, utilities, and real estate leaders. I love this tool because I can either go back and look at all the industry groups. Let me just come over here and do that. And rank them from top to bottom if I want to see what's leading in the market. Okay, we had 2 buyouts in the chicken industry. That's why that's up top. I could look at, in general, the stock market and look at the 1,500 stocks in the S&P 1500 with fundamentals and technicals. But let me go back to that sector page. What I like to do is I like to highlight, in this case, the top 3, give some love, and hit the gears. And what it's going to now show me are the industry groups in those top 3 sectors. I'm going to rank those from strength, and I see the top of the top. And let's look at those groups that are the leading groups in the leading sectors. And now what will happen is I'll get a list of stocks, and we're not going to spend much time with it. These are not high growth groups. Now, if I look at the 3 stars, that's going to show me groups with good earnings per share growth and undervalued. You won't see a lot because of the industry groups we're in. And we'll come back and we'll look at ingredient later. Tyson's was a takeout, and FDP looks interesting as well, but it's lower in its pattern. So I use this tool end of day like I just showed you. I use this tool from a top-down perspective, intraday, which it's so good because it's on real-time data and everything's constantly updating. And then I kind of like just to go into the whole market and look at, what are the true stars? Where are the crowns? And now I have a defined list of stocks that are considered undervalued with good earnings per share growth. And there's quite a few of them here because it's the S&P 1500. But I might look at the ones that are outperforming today and go drop them down. If I just do a take that. I could always just go into my, and we're going to do all this in a few minutes, by the way, into my trade station. I can drop the stocks in here and do what I refer to as flickies and flick around and see if I find something, but we're going to come back to that. So one of my favorite tools is Q. So I already looked at this and looked at this. There's another tool called Vital, and Vital is interesting because I could take that ingredient, type it in here as a root stock, and then it basically builds a list of stocks that are similar. They call them the peers. It tells me some fundamentals about ingredient. It tells me that 70% of the stocks in the list were up, clearly undervalued, which is what's here. I guess that's cyan. Here's a little bit about EPS growth and revenue growth, and then when I hit the peers, I'll get more information. I'll get a list of the stocks and look for the stars of the bunch. Canaries in the coal mine. Extended FANG list. As those who are my frequent followers know, that breaking above this trend line, and over the last several weeks I've been more bullish, the FANG, and my canaries trickled even higher this week despite being a challenging week for growth. Know your news and earnings. I can't remember a time, and I've been trading for a long time, where I've been so hyper-tuned to what the 10 and 30-year bonds are doing, or interest rates are doing. And I'm never worried about growth versus value changing on a daily basis. Clearly, it's something that changes over time, and that's rotation. But we don't just worry now about sectors rotating, industry groups rotating, but we're worrying about growth versus value, and it changes so fast. Very tough market. Manufacturing index, industrial production, retail sales, home builders index, permits, starts. Ooh, FOMC minutes. Those are always exciting. Will there be more mention of taper in the minutes than there were in the speeches? And then jobless claims. I got to give this a big week of news, folks, because of that. Still a lot of earnings. I've got a couple of the things on here, and this has not been a fun earnings season. In fact, one thing I look at to get a sense of how earnings are going in MarketSmith, and if you have MarketSmith, you can do this too. So we're going to look at this very simple. Where is it, Jeffrey? It is earnings. Upcomings, technical. Earnings gap up, 620. That's a good number. Must be a strong market. Earnings with a gap down, 1425. When the gap downs are outperforming gap ups, 2.5 to 1, you got to be careful with earnings. I'll talk about that later. So I have some Wally Mart, and I got a couple others up there. So I'll have to figure out what I'm going to do. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. We ended the week on a mixed note. For the week, record highs in Dow and S&P 500, but small gains. Nasdaq flat, down 0.1%. Small cap struggle, down over 1%. Bulk of economic reports were close. I showed you the University of Michigan Go Blue, my alma mater, consumer sentiment survey with a big downside surprise. That worries me. News flow will continue to drive the market with this fight between bad and evil, good and evil, growth and value, whatever. What's going to go on with the infrastructure bill? The Fed meeting in Jackson Hole, is that where they announced tapering? What happens with COVID? And I already showed you some of the earnings and news. I took heat this week, but I got lucky. I bought the prior week some Myrna calls, and then I sold some out of the money calls with crazy premium at 530. And then I was watching Myrna, and I decided to take my long calls off when Myrna was close to its highs. I started peeling it close to 500. I think it peaked at 497. Finished removing my long calls around 480. And then I left my short calls on. I would have been down fairly big this week had it not been for Myrna. And then I did 2 trades on UPST, which made a difference. We'll probably look at their charts. I expect more choppiness. The fact defensive sectors are up bothers me. The fact that the VIX is so low intrigues me. Still a good time to be in cash. Monitor the number of positions and size. All that said, I would take the market being done right now with those averages. Those are really strong averages despite how choppy it feels. Maybe this was the year not to sell in May and go away, but to sell in May and buy ETFs. Now, I trade aggressively a portion of my portfolio, and that's the high growth stock portfolio. But I have a lot of my money being managed by wealth managers, and they're actually having a pretty good year too. Look a lot like these returns. And one thing I noticed with the boring stocks, they're a lot less volatile. But we also know that last year, growth really outperformed. So, I could stop right here, couldn't I? But I won't. Very quickly, I look at the indexes, multiple different places. Here's the E-minis. If I look at 6 points, 1, they are in a buy signal from John Person. You can see that where the buy signals are the sell signals. Once they paint, they don't change. They're pretty damn good signals. Buy on daily, buy on weekly, buy on monthly. Second thing I look at is the color of the paint bar. If it's green, Alexander Elder Impulse Indicator, I can be long or holding, I should not be going short. If it's red, I should be short or holding, I should not be going long. If it's blue, it's neutral. Green, green, and green. I look at my position within the auto envelope. These are not bands, but they're Bollinger Bands. It can run for a while outside, but when it gets outside, I start to get nervous. I am at the top part, but I'm not extended. I can check off, that's good. I come down and look at the high jump at 70%. The little white dots are when I always expect the market to pull back when it's extended from its moving averages. We're not there. The Laguerre RSI, when it goes sideways up here is typically when you see the markets move a lot. I'll be looking for that red arrow to come in. How am I not bullish on this? I am bullish on the S&P 500 if I have to pick one. Everything can change, of course, Monday at 9:31. We look at the Dow. It looks very similar, except we've got a Laguerre sell, but we really haven't broken down on the Laguerre RSI. Weeklies are good. So I'll go back to the Nasdaq and show you, or to the E-minis and show you one flea. This red dot here says I'm starting to see some MACD divergence. I can get the divergence to run for a long time before the market rolls over, but that's one flea. On the Dow, similar pattern. Everything looks bullish. That Laguerre is a little bit not concerning, something to pay attention. This one's different. Here's your sideways market in the Russell with a red candle and a person sell signal coming in. It's at a weekly sell, monthly still, it's a long-term buy. This one's weaker. We already know that. The Nasdaq, sideways of late, in a buy, in a buy, in a buy. Lots of MACD divergence building up over the last 1.5 months on the weekly. So less excited. So I would say the E-minis and the Dow, to me, actually look better than the Nasdaq and then the Russell. I know the dollar matters a lot to my portfolio. And again, look at how good John Person signals are. And we're in a new sell signal. We shall see. Now I like to jump into HGSI. And the first thing I do is I go into major markets plus 01, hit the warehouse, and I bring up some of the major indexes. And then I look at top-down view, and I could see the best performer for the week was TLT. And you could see TLT having on the weekly a big hammer, and here reversing and a positive close off of the 200 and the 50. If this was a stock, I'd probably be buying it. When do I worry about the markets? I worry when the bonds outperform stocks. And what do I think drove this? I think this was driven by the consumer sentiment. But let's start with the S&P 500. So we have NYSE, Bitcoin, transports, Nasdaq, and some growth. And down here we have short bonds, the VIX, bunch of Cathie Wood stuff, Russell 2000. That's got to tell you how your growth stock and small stocks are doing. Not too good, are they? I'm not picking on you. I still got some too. All right. How can you be more bullish looking? This is the S&P 500 cash markets, and you could see the move off the March lows. The only thing that is bad about this is eventually everything comes down, even rocket ships, and this is a rocket ship. You know, no one knows when that's happening. I certainly don't. So, new high set on Friday. You know, it's sort of still a sideways feel to me. I look back at that 2007 top. It looks really good on the weekly, and frankly, it looks really good on the daily. It just looks like it's losing. Is it losing momentum? I don't know, because it broke out to new highs this week. You got to be bullish. And the nice thing about this gradual run-up is it's not that far away from its moving average. It's a pullback to the 50. It's only 3% away. Let's look at the Dow Jones Industrial Average. Not nearly as pretty with the clear sideways movement here, but look at how it's broken out. And the person market catcher just shows you the improvement in relative strength of the Dow. So everything I said about the S&P, I can say here. It looks strong. Everything comes down eventually. This is only 2% above its 50, and really only 10% or less than 10% away from its 200. Hard to say it's extended. It's at new highs. Again, if it wasn't for the time factor, I probably wouldn't be as concerned, but everything comes down eventually. And August and September are times where that likes to happen. Russell 2000 ETF, yeah, much different. Sideways move, closed below the 200, closed below the 50, failed at the 50. You know, this one looks to me very range bound, and those who've been with me know that something that I've been doing for years. I mean, we clearly are in a box here, and we're in the middle of that box, and it's be hard to get excited to the long or the short until we break out of that box. But we're about 25. That box has got a width of about 12%. And so top to bottom, you get nice micro corrections or meaningful corrections without even breaking out of that box. So less bullish there. Let's look at the Nasdaq. Person sell signal on the Nasdaq on HGSI. That's interesting. So on the Qs, on the Nasdaq 100, I did not see it, but clearly sideways. The calculation, the basic formula between the different programs is the same. And you did have a sell signal on the Qs in Thinkorswim, but the different programs have a little bit different formulas, so there could be some day off here and day off there. So sideways movement, again, am I bearish or bullish? Whoops. think back to the S&P 500 2009 chart. We are barely making new highs on these things. We're losing momentum, but we keep making new highs. So I think it's time to be careful, not be a hero. This is not coming off of a bottom. That said, could the markets go higher? Sure, they can always go higher. Now let's look underneath a little bit. Hold on a second. All right, so let's start to dive into Nasdaq a little bit. Let's look at biotech. Biotech is tough because you can look at LABU when it's down and IBB when it's up, and it's because IBB's got a huge Moderna. So let's make this a little bit more of it, a little bit easier to see. So biotech has turned down. It had a beautiful run up here. Topped out here, switched to PSAR. Still in a long-term weekly bongo. It is 3% away from the 50. To me, that's the natural target. Biotech looks a little weak here. Philadelphia Semiconductors pulled back into the 50 and bounced. So I'd be a little bit more optimistic there if I had to pick. But again, none of this matters if the market opens up with big futures up and futures down. If we look at the IBD 50, and again, just be very clear. I have followed the teachings of O'Neill forever. I subscribe to MarketSmith, investors.com, the newspaper. I used to be a Daily Graph subscriber. I buy into their story. It's just not working. It's not working. Markets are setting new highs, and the 50 is nowhere close, and looks like it's turning down again. If I look at the FANGs, a lot nicer looking chart, lower left, upper right, flagging here. Pull back to the 50 would be an opportune place to move up. As I said, it actually was up. At least the canaries were up for the week. The FANGs don't look like they were up. The FANGs on the week were down 3%. So my canaries were up, but the FANGs were not. New red bongo, that's a little bit more worrisome. Do I see strength or weakness in this market? The indexes look great. Underneath, it just doesn't look so great. What else could we look at? We could look at some of the Cathie Wood stuff. Here's the bonds. We know the bonds look good. That's not a Cathie Wood stuff. Here's tech and robots, a sell signal at the 50. Mobile breakdown in a squeeze, a person sell, and a kahuna to the downside. Not real exciting. Here is innovation. Here is genomic revolution. Here's the ARKK, one of the very popular funds that people were talking a lot about a week ago. Looks like it's rolling over. Israel broke down. Still above the 50 on the next gen, and space is just messy. And then lastly, Bitcoin. We talked about it last week, and I said I was buying Bitcoin or some of the surrogates. I did. It popped up early in the week and did nothing. So, are you bullish or are you bearish? Sometimes we got to go below the futures in the major indexes. I think underneath look a lot less attractive. Let's look at the dollar. We talked earlier on, seems like an hour ago, which my wife just reminded me because it's time for breakfast, and I agree with her. The dollar almost looks like it's about to roll over. It's got a double top in here, rolled over back here at this point. It was support at this area in the past. Probably a natural place to see the dollar roll over, and it has. So right now, dollar looks like it might soften some. I'm a believer it's got a lot to soften, but we'll see. The VIX, we don't even bother looking at. We know it's at a low. With all the splits, it doesn't look well in HGSI. If we look at gold, dollar week, gold should be up, right? A little bit, but it's bouncing off of its 500-day moving averages right here. So, yeah, gold looks a little interesting the last couple of days. I really like to see it get above this congestion area, lots of overhead supply, and it's just not been doing well. Is this the time? Yeah, short term, you buy Nugget and JNUG and you get out when it stops going up. But those are risky, and they've got to be short term unless we want trends like this weekly trend, okay? And the weekly trend now is down. These are counter trend rallies. It's hard to become rich trading counter trend rallies. Silver bouncing around off the bottom, and gold miners, which again, dollars weak, these should be up. They're not that exciting. All right, next thing I like to do is go down to industry groups. So that's 07, that's at markets, 174. And here's where the real deterioration showed up to me. Instead of 80 or 90 to the upside, I've got 20. To the downside, I have 32. So not a big difference, but the big difference is we have a lot less bullish industry groups at the end of the week this week than we have on any prior week of the last 4 or 5. Things that we like to typically buy: specialty pharma, oil exploration, casinos, oil gas services, oils, refiners, healthcare supply, life science equipment, home builders, medical devices are all to the downside short term. If I look at a more intermediate downside, I've got 54 on a 5-day window, and I've got to the upside 40. So I'm seeing a market that's weakening. It's not dead yet, and since the index futures are still bullish, and I'm typically more interested in looking at longs than shorts, I like to play contras and maybe do some puts for the shorts. Let's just look at some of the things that are leading. So these are by force, which is what I use as a surrogate for momentum. These are the 20 or so industry groups that are moving up. What I like to do in HGSI is highlight, then hit the right clicker on my mouse, then the left change to industry group, and what comes right up to the top are those stocks that are leading with momentum. For those that don't know force, it's an Alexander Elder indicator. Today's close minus yesterday's close times volume. You plot it. You take the 2-day and the 13-day exponential moving averages, and he uses those in his charting and trading. I look at this as kind of like volume, like momentum, and so I rank them by force. So I'm long currently the stock, which is Novavax, and I'm going to tell you Novavax versus Moderna. Oops, I'm going to leave this one. So why did I go long Novavax? Because I went long both of them at the same time, because I thought with maintenance we'd see a pop. Now you had a sideways move, and I went off the 50 on Monday or on Friday. Global breakout from a squeeze, a number of viable gap ups. It's a messy chart. I can't say that this is driven just by the chart. There's some interest when I look at, let me just show you what I look at. I'm just going to put this up here, and then I'm going to take a quick stop, pit stop, and then finish. Pit stop meaning breakfast for code. Look at the earnings per share growth coming in. They got a bit of a delay and there was a pullback, so I looked at that as a buying opportunity. If they come anywhere close to this and you keep the multiple at 8 to 10, it's a $320 stock. The other thing that interested me here is if I look at market cap, the market cap is 19 billion. Compare that with Moderna, mRNA, where the market cap is now 157 billion. And when I was getting out of the stock and leaving a short position, it was over 200 billion, making it the most valuable biotech. We'll come back to that. So obviously you buy things at your own risk. I think Novavax looks interesting, and if I could draw, there's probably a bit of a handle here, or rather a cup here. Let's see if Marcus Smith gave it a any kind of a thing. Sometimes I just like to look at the patterns that Marcus Smith puts on. I don't think so. Nah, it's too loosey up here. Okay, so I told you I bought some Novavax. Cassava, I don't know if they're partners with Biogen IDEC on their Alzheimer's drug. They've moved the same time. Maybe they are partners. What do I see here? Big run up, pull back, running again. I have to know more about this. It's certainly not growing on sales and earnings. Regeneron, we talked about this one back here. This would have been a great buy. It's run up to over 600 and a Bible gap up. It had a gap up. I didn't say Bible gap up on Friday. Global breakout from a squeeze, pocket pivot, approaching prior highs. I think I'd be raising my stops on this one, but what a beautiful run this has had. And then we get to the index. Typically I don't go below. Let's just look at Moderna. You know, those who follow me, you know that I hate this pattern. They run up, they come back down, they go sideways, and I sometimes will buy it when they run again. I decided to play it hard. So my neighbor Kathy, when I told her I bought Moderna, I think was mad at me. She wasn't mad at me, but she did make a comment, I think I told her on Monday when it had this crazy day, about I told her not to buy, and I tell people to be careful with it. And I do. I mean, I was afraid of it when it had a $90 billion market cap. But when its market cap got to over 200, you see it's come back quite a bit. It had a market cap bigger than Amgen. And had a market cap bigger than Merck. And I think the market cap caught up with it. What's most worrisome if you are a bull on Moderna, look at the weekly bar, is that the last couple of days occurred despite opportunity growth with maintenance. So, let me see. I'll just tell you what I bought. When Moderna was 420-ish, I bought, no, when it was actually a little bit less than 420, I bought some $420 calls. I paid about $40 for them. I sold a 420 put and had a 400 protected put, so sort of a Scott synthetic. It actually moved against me. So let's say I bought it on, was this Friday? Thursday? I bought it Friday morning. Yeah, it was less than 420. And then it traded down. And I actually got nervous because I am concerned about buying something or shorting something that's in a, of having the short put spread in something that's going to come down. So when it did this, I actually covered the short put spread for a small loss. I paid for that loss by selling $530 calls for $10 a pop. So I had between $30 and $40 in it per call. It ran up to $497 on Monday. Actually ran higher on Monday. On Monday's high was $494. Tuesday it ran up to $497, and I said, this is ridiculous, and there's no way I want to be, kill that tool, that I want to be long Moderna when it's got this expensive. So I sold my long calls and I left my short calls on. Now the stock is closed less than 390, and I got 530 calls dated in September. Interestingly, there's still about $5 or $6 in those calls. I'll get bored with them and I'll probably sell them soon, because the most I can make on them is $5 and the risk is pretty high. But the likelihood of us going back to 530, think about all the overhead supply that we built the last 3 days. If only I can get out. So that was a very quick reversal of my stature and actually made me some money. I probably confused you. I apologize for that. So biotech's the top group. Going down, the next group is precious metal mining, which is kind of interesting. Maybe the dollar weakness will persist. It's kind of a bottom fish, Pretium Resources, PVG. Mobile breakout from a squeeze, a new John Person buy signal, and a kahuna. Big reversal on the weekly, taking it 1, 2, 3, 4, 5, 6, 7, like 7 weeks on this candlestick here. It's below the 200, which I don't like. The weekly bond goes red, tells me it's in a downtrend. It's not that exciting to me, but could this go up to $11? Sure it could. Probably will. Belt hold is what that candlestick is called. Kirkland, this was a great stock. I go back about 4 years. From the time it came to market, it had a great earnings per share growth, and it just ran from under 10 to up to about 60, and it's not been the same. Sitting on the moving averages, bongo up, pocket pivot, kahuna, still a person, sell. It's gold. Gold is sideways, that's sideways. Wheat and silver metals, very sideways, but a good place to buy because you're sitting right on the 200. You've got support very close, so you can set your stop. But it's in a downtrend with the weekly bongo red. Hard to get excited about things in downtrends just because of a short-term move. Large pharma, get excited. This might be the best way to be playing COVID. Why? Pfizer is a big kahuna stock. It is partners with BioNTech. It's going to have massive earnings per share growth and revenue. Likely will allow it to acquire some more companies and to do investment on R&D. It's not really 7.3 dividend. If I just go into, say, I'm just going to look off here in FinViz. Let's look at Pfizer. On Pfizer, it says dividends 3.22%. So, is it extended? Absolutely. You got to be careful about that. I'd certainly look to buy it on the pullback. But you know what? I bet you make money if you buy it here, just because, it's not going anywhere. It's got one of the approved vaccines. Its market cap at $270 billion was basically $50 billion for the rest of the company and $220 for the vaccine if we treat it anything like Moderna was, which was, the reason that I did what I did on Moderna and got out was market cap. The reason why I haven't been in it for a while until now was market cap. Just ultimately, if things are way overpriced, they're going to have problems. AZ, this one looks interesting. They also have a vaccine. It's not approved in the U.S., probably will never be approved in the U.S. It had clotting issues. We learned about those with the J&J vaccine as well. But you want to buy something that's at a good buy point. You've got a base for about a month. You've got a mobile breakout from a squeeze, a new person buy signal, 2 kahunas in a row, which always gets me excited. It's got good earnings per share growth. Again, I did say it has a vaccine, and it's about to break out above its chandelier stop. I think Astrazeneca looks interesting here. In fact, maybe we'll come back to it. Let me just write myself a note. Hold on a second. New text document. Open it up. I'm just going to, I have a tendency of saying I'm going to do things, and I get so caught up in what I'm saying I forget about it. All right, so AstraZeneca looks very viable right here. It pays a 3% dividend. J&J, Dan Fitzpatrick likes this. I think it's run too much. Also has a vaccine. Merck is making vaccines for one of the others. Merck is this great cancer company right now with a drug called Keytruda. I'd rather buy one of the others based upon the pattern. AbbVie, I've been in and out of this one. Last time I bought it, it came right back. But what a good buy point. It's sitting on the moving averages. You can see it's above the 50 by 1%. Nowhere close on the high jump. It pays a 4.4% dividend. This is also interesting to me. Bristol Myers Squibb, another great cancer fighting company, 2.8% dividend. You could buy it off the 50. Just don't see a whole lot of momentum there. I like large pharma here. I would be interested in adding to Pfizer and potentially buying AstraZeneca. Infrastructure software. Leader in the market. If you don't believe Microsoft is a leader, look at this move here in the weekly. Now, this is about 45%, almost 50% move, maybe over 50. Long and steady, breaking out all-time highs on Friday. Fundamental-wise, doesn't have a whole lot of earnings per share growth. I own it. I think it's pretty fully valued. Does it go higher from here? If the market goes higher, Microsoft kind of is the market. Market cap, $2 trillion. Remember, we were waiting to see the first trillion company, and then they doubled. Wowzer. CyberArk popped on earnings. Looking at the numbers, they didn't look great. Obviously, they beat expectations. And if you don't have a cybersecurity stock, this is an Israeli, 2 kahunas in a row, pocket pivots, kahunas, John Person buy, mobile breakout from a squeeze, uptrending weekly bongo. I hate to say it, but what's not to love here? ServiceNow. This has been kind of choppy, but if you look at this, let's just take it out to a monthly. Wowzer. 2018, $100, $150 a share to over 600. It's gone sideways for the last many months. I would say it's at least a hold. I don't see any big compelling reason to jump in it now, at least on the daily. Fortinet, another of the security plays. Boy, wouldn't you love to be owning that, have all your portfolio in it. Wow. A double since January. Little flag and a new breakout. It's just extended is my concern. Old name Oracle, setting up for another run, perhaps. This is what I call top-down, what people call top-down investing. I went through, told you I thought about the market. Now I'm looking at the industry groups that lead in the top stocks. This is a buyout, Pilgrim's Pride. Mondelez, this has showed up on a number of my scans. Notice consumer staples. If the market is weak, then this might be a place to play. I like to see it take out its chandelier, but this one looks like it wants to go higher, especially with Staples leading, Tyson's Food another buyout, bakery. Again, General Mills and Kellogg's, 3.5% dividend on Kellogg, breaking out of its downtrend here. Just not the kind of stocks that I typically like to buy. I know I've gone a long time. This is probably the longest one I've done in ages. I'll look at a couple more. I'll show you the stocks that I like, and then I'm going to look at Astrazeneca. Steel, no shocker with infrastructure. I own a bunch of these. U.S. Steel breaking out to multi-year highs. Look at the earnings per share growth. Under demand, PE less than 10. Nucor, big breakout down here. The reason why I get excited, global breakout from a squeeze. Kahuna, the time to take it was probably a couple days later when it broke above the 50. Steel Dynamics, global breakout from a squeeze, break above the 50. John Person buy, pocket pivot in Kahuna. Commercial metals, man, this was on my list. I didn't take it. Saw this and backed off, but a doji on the 50 and then it took off higher. You can't buy everything, and I'm overloading this group. TX, another one that looks good in this group, sideways a couple of days, also has amazing earnings per share growth. So steel producers continue to look good, and we'll just do raw materials. Cleveland Cliffs, we talked about this before, a big iron ore producer. Junkie from a loosey-goosey, the lower left, upper right. Don't like the doji on the weekly and the daily, but I do love the earnings per share growth. I like the fact it's under demand. And BHP, I heard something happened at BHP, which is why this was running. I also own some Schnitzer Steel. Why do I own Schnitzer Steel? Because mobile breakout off the 50, a new person buy, pocket pivot in Kahuna. I'm like a broken record. All right, so I would typically go through the top 10 groups, also look at some of the shorting groups. Let's spend a couple minutes looking at AstraZeneca and how I might buy AstraZeneca. Sorry for the dog. There must be somebody walking outside or he sees his reflection in the window. So here's AstraZeneca. Obviously, it's been in a downtrend on the. I'll make that a weekly again. Oops, my bad. It's been pulling back from a big uptrend. Looks like it reversed this past week, looking here on the daily chart, pull back. Looks like it's ready to break out. This is what I like to buy. So let's expand this. And first thing I want to do is drop in my pricing tool. Notice that this will change every time I move it. So let me bring over my notepad. So the close on Friday was 58.48. Typically, I would put a buy point just above the close. I'm going to look here, and I see this red line, which is my chandelier. It's at 58.69. Let's put our stop at 58, our buy stop. So chandelier at 58. So I would want to see this thing to continue up. And I know that chandelier is potentially could be resistance. So I'm going to put a buy stop at 10 cents above the chandelier, which is 58.79. Now, what is my sell stop going to be? Which will be placed after I take the long position. Typically, I want to go the low of the last 4 days. Now, the low on the week is 56. Let's see what the low of the last 4 is. Looking right here, 56.71, 56.48, 56.24, 56. I'm going to put my sell stop at 55.95. So I am risking $284 if no gaps and get filled at price. Okay. Now, if I am willing to lose up to a trade, then I can buy 2,000 divided by equals, get my phone out because my days of doing this in my head are done. Is it 800? 700? Let's see, 2,000 divided by 2.84 equals 700. All right, so I can buy 700 shares. So my, and I hate to use this word, options are a long trade, buy stock, I could buy I could buy calls. I can short puts. I can buy a call spread. I can short a put spread. I can do synthetic stocks. I can do Scott synthetic, which adds a protected put. What I don't want to do are directionless trades like, differently. I don't want complex in options or a butterfly with gains capped. That's just my personal feeling. So if those are my options, this week it's going to work because I signed all my agreements. So apparently I had lapsed. I'm going to bring out my Options Pro. Not mine, I have it. And we're going to stick in here AZN. September is 33 days. Let's look at October calls. Let me close this up. Start from scratch. So again, I'm interested in Astrazeneca. Here's my options change. And I'm going to be interested in October calls. Okay. And at the money is either 60 or 55. I don't know if they have a 57.50. Let's see. Oh, they have a 57.50. So we're going to look at 57.50 calls, but I wouldn't trigger them until the stock trades up a bit. We already looked at the chart on Astrazeneca, and just to review it, what's got me interested in is pullback, breakout. Is this sort of a cup and a handle breakout? I don't know. I'm probably dreaming. I always see cup and handles. So I'm going to bring up my spread tool. Got Astrazeneca. We're looking at the monthly options, which will be the 15th. There might not be a 47 and 50. Oh, there is. Perfect. We're going to decide we want to look at bullish spreads because we're bullish. So that would be long stock, long call, short put, bull call, bull put, synthetic. All right. And we're going to look at 57.50, and we're going to look for a minimum move of $5. All right. So I've got a number of different things here. On the spreads, I gave two different differences. One, $5 apart, one, $10 apart. So these are the potential trades that I would consider. If I go long the stock, oh, there we go. That's what I was looking for. I'm just going to talk through these various, no pun intended, options. If I take if I go long the stock, I have this curve. This is the price I'm paying. If the stock moves up, it goes to the right. You can see I'm in the profits right away. If the stock goes down, I'm in the loss right away. My break even is the price I buy it for, which is the current price, which is $58.48. My maximum risk, if I was to buy, let's just make everything simple on me. We're going to make it 1,000 shares. Well, right now it'll be 10 times that. So 1,000 shares would be 58,000. So for every 100, it's 58.48. Obviously, we would have our stop in here at whatever price we said it would be, so that the most I can lose is the amount we already projected. So the story of buying the stock long, I got infinite profits. That's good. I have maximum risk is big, and it's going to cost me, I don't know why it says 0 here, it's going to cost me $5,840 some for every 100 shares. So it's expensive, it has infinite risk, and the most infinite gain, and I can lose my whole investment. That's long stock. Nothing wrong with going long stock here, by the way, folks. How about if I go long a call? So I buy a call, each call is 100 shares. I'd end up buying 7 of them or 10 of them. $57.50 strike price. It's going to cost me $2.50 to control 100 shares. So it's going to be $255 for every 100 shares. Let's open it up. Look at the impact of a long call. Again, I'm only talking 100 shares here. You'd have to add a 0. So here's the price I buy it at. And what do you see here? My losses are capped. The most I can lose is what I pay for the call. That's the beauty of buying a call. I have very little risk, only the premium. I was willing to risk on this trade $2 and what was the number? 84 cents per share. Well, here I'm risking the most I can lose is $2.55. Wow, I can't, that's awesome. And I've got infinite gain. What's the problem with this? The problem is the stock has to move $2.50, the amount of my premium, for me to be in the money. So buying calls is great, okay? I can control, instead of for 58.48, 100 shares, I can control 100 shares for $255, all right? My opportunity is infinite gain. The downside is it's got to move in my direction. And the other thing that's a downside is I may ultimately be right on this trade, but it's got to happen before October 15th. So long call right here, infinite profits. I like that. I've got controlled risk, and my cost of getting into it is the $255 per 100 shares. That's a beautiful trade, and you can't lose any more than you would if the stock had maximum loss. The negative being time limited. I'm not a big spread guy in this stock. I buy spreads all the time, but this one, the price is relatively cheap. But let's look at this bull call spread. So in this bull call spread, I'm trying to lower my cost of the trade. So it doesn't really do that in this very much, and that's because the 67.50 call has very little value. So let's go look at the shorter, the 62.50. So here I'm saying, you know, I'm risking $2.50 on this trade. Getting 2-to-1 return I can live with. So here I'm buying a $57.50 call. I am selling a $62.50. The most I can make on this trade is $5. My cost is not $2.55. My cost is $1.87. So now, if I elected to do this trade, the most I can lose is $187. The problem is I've capped my gain with that short call. Now in the Moderna, I priced it so high that I knew I would unlikely hit the short call and lose my position. But Moderna, the calls were very expensive. Here, I'm saving $70 per 100 shares, but I'm capping my gains. A bull put spread, I don't like this trade at all, to be honest with you. In the bull put spread, here I'd probably give it bigger. Bull put spread says, I'm pretty sure this is going up. And so in the bull put spread, oops, that's not the one I want. I'm talking about yeah. In the bull put spread, I'm going to short an at the money put and cover myself, go long a put $5 out. I'm going to get paid $1.58. The problem with this trade is the most I can make on this trade is the delta between the spreads minus what it costs me. I don't pay $1.58, rather. I'm paying $117. I'm getting paid $117 to take this because I'm selling the spread. Most I can make is at $117. I don't like to risk $500 to make $117. That said, some of the richest people make all their money by selling puts and put spreads. What I like is a synthetic long. Now look at this synthetic long. We're going to play with this for a second, and then I'll look at my buy watch list. My synthetic long is I'm going to buy a 57.50 call, and I'm going to sell a 57.50 put. It will have the exact same P&L as buying the stock. The exact same P&L as buying the stock. But instead of tying up 58.48 to buy 100 shares, I'm going to actually only tie up $102, $103 per 100 shares. So it's a trade that I love. It's the exact same risk and gain of buying the stock. And depending upon the stock, sometimes it costs me a few pennies or $1, and sometimes I get paid $1. Now, what's the problem with this? Well, if you buy the stock, you know what your maximum risk is. The whole thing. If you buy this, your maximum risk is the whole thing. Your maximum gain is infinity. On the stock, you're going to put a stop in and you're going to close it out if you hit your risk. You're going to close this out if you hit your risk as well. So I don't have any problem with that. Where I think people get into trouble is they don't close it out, or they say, man, Jeff, if I'm willing to lose $2,000, why don't I buy 20 calls? 20 of these synthetics. I'll control 2,000 stocks, and it's only going to cost me $2,000. And the answer is because you could lose your shirt. So hence, I have this thing I call the Scott synthetic, which is really nothing fancy. It's a synthetic call. And I construct the Scott synthetic by taking a synthetic, and then I'm going to add an option leg, and I'm going to buy a put, say at $55. We'll do that. So now, just like a call, I've capped my risk. I get the entire upside. And the reason why I like it better than the call is the long call was going to cost me $2.55 a share, or $255 to control 100. I can control 100 here for 174. Now, the downside of this, and there's a downside, and I want to point it out before I leave this, a couple of downsides, is that not only am I risking the $174 if I'm wrong, but I'm also risking $5 here, which is $2.50 here, which is the delta between my protected put in the call. So I'm risking $2.50 plus, I'm risking $4.24 per spread maximum loss versus risking just the $2.55 on the call. Why do I like this? Just because it's cheaper to get in and I'm bullish and I can still manage the position with stocks. Now, I could come in here and I could say, I want to be cheaper. And I can come back in here and take this protected put to 52.50. And now what happens, I lower my cost even more, but my risk is bigger. So I like the synthetic with the protected put. It covers my ass. It looks just like a call, but it's cheaper to get in, and I can control how much I pay by the cost of that protected put, because the long call and short put will cross each other out. I can inverse this and do a synthetic short as well. The other thing that's problematic with this trade is that there's a 3.1% dividend and you won't capture the dividend. So what were the important points of what I just did, in my opinion? All right. I started by picking a stock that I was interested in buying. I looked at the stock chart and I decided to go long above resistance here. By the way, this is the industry group strong. Okay. So I set a buy stop. I then looked at the chart, and it just happens that this bar right here which closed at 56, is the lowest bar going back to May. There is no way in Hades that I want to be long this stock if it goes down that low. But it was only, a modest ways away from the price. So I'm not risking 8%. I'm risking 6 or 7% at most. So I like that trade. I like the calls. I looked at various options that we could take as well. All right, I can't believe this is almost 2 hours. This is like the longest ever. Maybe I'm not going to get up in the morning and do them anymore because I talk too much. Let's look at here's my list that I'm interested in following. And as always, I'm going to start you by doing this. And you're going to see there's still some steel producers. I think there could be more room, but it might get bumpy if the House decides not to pass or threatens to not pass the infrastructure bill without getting the larger one passed. Notice utilities. I mean, some of these don't even, they look like growth stocks coming off the bottom. That's Sempra. Atmos. And look, mobile breakout from a squeeze. I should give you more shares. That doesn't look like a bad stock at all. 2.4% dividend. If I got utilities, I'm worrying about the market. A bunch of REITs. Remember, REITs are not necessarily the best way to play rising interest rates, but REITs are an interesting bag. Looks like Digital Realty Trust. Sideways move, looks like it's breaking out here, pays a 2.9% dividend. Packaged food, Kellogg, I couldn't resist it. I mentioned Upstart. I remember I told Lori Jones that I actually went long this going into earnings. Why did I go long? Here's where the earnings came out. I went long because I broke above the chandelier. I knew earnings were there. It was a limited risk position and it made a lot of money. All right, simple as that. It was a risky play, but it was driven by the chart. I'm still in it with a couple of trades. Marine shipping, Starbulk had a nice run. What do you hear now about container ships? It's getting higher and higher the costs, harder and harder to get goods. Look at the earnings per share growth, trades at a multiple of 9. Zim, which is also in that group, an Israeli shipper, looks even better, I think, from a buy point, but no dividend. Large pharma, we talked about AstraZeneca, it's sitting right here. Home builders are still strong. We got some home numbers this month, so be careful. Here's KB Homes. I've been sort of lazy, and I just bought ITB, and I keep rolling it up and out. And I sell calls against it. I didn't even have the drawdown that some of the builders had. Don't know this guy at all. It's not a biotech, George, if you're listening. It's a solar play, but it looks like a reversal off the bottom. I have fond memories of stocks that do nothing for a while, many weeks, and then have a bunch of momentum come in. That's what Tandem looked like when I bought it at 6, and now it's 110. And I gave it to you the day I bought it. Who says I'm not a nice guy? And then lastly, so the base metals, Alcoa is broken out. You look at the earnings per share growth, maybe it's got more to go. So let me just summarize this week and say, market risk, market risk, market risk, market risk. Be careful what you do. Don't go giant positions. Don't have too many positions. You know who I'm talking to. And live to fight another day, because this is the most painful all-time high markets I've ever lived through. And this growth versus value, different sectors of the market work at different times. It's just a tough time. Take care, everybody. Promise not to be 2 hours next week. Thank you and good night or goodbye.